The hour 10:15 have arrived. We'll call the House Tax Committee to order when we have a quorum. So members, before us today, we have the markup of the omnibus tax bill, House File 4385. So just to kind of lay out the day, if I might here, we're going to go from 9 to 9:45, and we'll be hearing from Nonpartisan Research and Fiscal to describe the bill. And when we have a quorum, we'd probably put a few amendments on here to kind of get the bill in the shape that we'd like. And then it's my intention that we would meet a half hour after session in this room, so we can just kind of leave our stuff here. Nothing valuable, but just bills. And so a half hour after session, then we'll be taking public testimony, and we'll give the department time to visit with us, as we'll give them as much time as they need. So it'll be public testimony, the department, then we'll go into recess so that members can get into their caucuses and visit about the bill. And Chair Marquardt, what do you think of our time on recess? I'm totally open.
Say one of the things that
Thank you, Mr. Chair.
For the
Right, after the
caucus.
test.
Yeah.
I would think an hour would
An hour?
be.
Okay, so we'll figure, we'll come back half hour session, take public testimony, we'll listen to the department, then we'll recess for about an hour. And then we'll come back in and start marking up the bill with amendments, and we'll go from there. So should be a great day today. Now, also, as you know, after session, we have Ways and Means Committee going on at the same time. So we're coordinating with Ways and Means. As votes come up over there, there may be a few short recesses because we have quite a few members here that are on Ways and Means. We'll want those members on both sides of the aisle to go down and vote on the bills in Ways and Means. And then we can come back here. So I don't know, we make, well, I guess I'm on Ways and Means, so I suppose we better recess and get down there. Chair Carlson.
Yeah, just a bit of friendly advice. You may want to announce that when people are leaving. When I've chaired a committee, sometimes people sitting in the audience, they'll say, gee, those members weren't paying any attention. They were coming and going. And I knew they were going to another room to vote. So announcing it now is great, but you might want to, when that's happening.
I think we'll do it again. I think that's good advice, Chair Carlson.
Just from the standpoint of the viewing public and people in the audience.
Know that why are all these people leaving, and is it something I said, or I'm not sure. So with that, I think that's good advice. We will do that. So we'll also talk about that after we've had public testimony. We'll go into recess for 1 hour. Then we'll come back and mark up the bill. And so anywhere in that time, now it may also be, we'll want to know where any members are caucusing, because we may just, on our side, I don't think we're going to caucus. I think we might just go down to Ways and Means. But we would want to know where you're at so we could notify your caucus that there's a vote coming up or something like that. So we'll want to have communications wide open today. So with that, we will be recessing, and members, please make sure I say recess, like 10:15 instead of adjournment. I've done that before. That's not a good thing. We will be recessing, not adjourning until we have the bill done. Okay, so with that, we're not quite at a quorum yet. Let's start with Mr. Michael and Mr. Williams on House File. I'll move House File 4385 when we have a quorum. So to House File 4385.
Thank you, Mr. Chair and members. My name is Sean Williams from House Research. So I'm going to be talking about Article 1 of the DE Amendment. Article 1 is the federal tax conformity article, contains conformity to 2 pieces of federal legislation that were enacted since we last conformed to the federal Internal Revenue Code: the Disaster Relief and Airport and Airway Extension Act, the Tax Cuts and Jobs Act, the Bipartisan Budget Act of 2018, and the Consolidated Appropriations Act of 2018. If you look on pages 2 and 3 of your summary, there's a bullet point list that sort of contains some of the provisions of those bills. I'm not going to go through those in detail. We've sort of talked about them in earlier sessions of committee, but I think there was some confusion. So the bullet point lists on pages 2 and 3 of your bill summary are not all included in the DE amendment. Those are the provisions of the federal bills. At a high level, on the individual side, Article 1 moves Minnesota's income tax system from a federal taxable income to a federal adjusted gross income starting point. That means Minnesota will have its own standard deduction and itemized deduction. For the most part, the itemized deductions we've adopted in the state in the article match what is allowed at the federal level after the enactment of the Tax Cuts and Jobs Act, with the exception that the deduction for property taxes is capped at $30,000. We also instate our own personal and dependent exemptions. Those exemption amounts are $4,150, which matches the tax year 2018 amounts that were announced prior to the enactment of the Tax Cuts and Jobs Act. The standard deduction under the article is $1,000 higher for married couples filing joint returns and $500 higher for single returns and married couples filing separately. The article also contains cuts to the second tier of the individual income tax rates. Those are phased in over 3 tax years. So the current second tier rate is 7.05%. I believe after the author's amendment and the numbers reflected on the spreadsheet will indicate that we're going to 6.95% in tax year 18, 6.9% in tax year 19, and 6.75% in tax year 20. On the business side, Article 1 conforms on virtually all of the business provisions, except for bonus depreciation, the GILTI and FDII provisions, and I believe Mr. Michael will discuss those in more detail as we proceed to the section-by-section discussion. Moving on to Section 1 of the bill, and sort of throughout the bill, there's a number of sections where we're conforming to the federal law's inflation indexing. So previously, Minnesota's brackets and federal brackets were indexed using the Consumer Price Index for all urban consumers. The bill moves to chained CPI, the Chain Consumer Price Index for all urban consumers. Without getting into too much detail, that's a measure of inflation that grows somewhat more slowly than the old measure of inflation. So that has sort of different effects on different provisions. But so Section 1 of the bill moves to the chain CPI measure for the purposes of the revenue recapture programs and revenue. Section 2 updates our definitions to conform to the 4 federal tax laws I mentioned earlier for the purposes of revenue recapture. Section 3 amends the filing requirements. So because after this bill if this bill were to be enacted, the standard deduction amounts in Minnesota will be lower than at the federal level. There are some individuals that will not need to file a federal return that will need to file a Minnesota return. So this amends the filing requirements to indicate that the Commissioner of Revenue can establish procedures for determining who has to file a Minnesota return. Section 4 is a change to a cross-reference. Section 5 and 6 are both conforming changes related to us switching from federal taxable income to federal adjusted gross income. Section 7 adds a definition of surviving spouse that's used it's used multiple times throughout the chapter and including in the new Minnesota exemption amounts section. Section 8 updates our definition of net income. This is sort of where the meat of the change from federal taxable income to federal adjusted gross income takes place. I would note that in this section, corporations, estates, and trusts will continue to use federal taxable income as their starting point, so it's only individuals that will be moving to federal adjusted gross income. Section 9 of the bill adds a definition of federal adjusted gross income. And Section 10 adds a definition of taxable net income, sort of updates our existing definition of taxable net income to include the new personal independent exemptions as well as the itemized and standard deductions.
Excuse me, Mr. Williams. The Tax Committee will be officially called to order. A couple things here. First of all, and thank you, Mr. Williams. So we do have a quorum, and I had mentioned that the department would be going last, kind of wrapping things up. Actually, once we get into public testimony, the department will be going first. They'll be first on the list here. So then we'll give them the time that they need. Also, just a little bit of an announcement here. At this time of year, at this time of session, there's a lot of amendments. A lot of our friends in the government relations area are feeding members with amendments and so forth. A couple things. First of all, it'd be nice if those amendments had been heard in some committee somewhere. That's very problematic for me to try to accept an amendment. I want to accommodate members best I can, but it's very tough if the issue hasn't had a hearing. If we kind of let that door open, then I think every session that there's a tax bill, I wouldn't have hearings. I'd just wait till the day we mark up the tax bill, and I would just get it on that way. So a bit problematic there, and that's very bipartisan. It's not one side or the other. So let's just kind of keep that in mind. Because we do check out where these bills or amendments are coming from, and some of them are stuck deep in committee somewhere in the dark of night, a smoke-filled room in a right-hand lower desk drawer that's all dusty. And so there's a reason why some of these amendments haven't got too far, and so we bring amendments forward. I'm going to go to the chairs of the area that is relevant to and visit. I've had just this morning several, but that being said, and it's very bipartisan. This is a very bipartisan committee. So just keep that in mind from our friends in the government relations community, that if you're trying to feed some of these things through that have never been heard that sound really good, it's probably going to get kind of a cool, it'll be cold. It'll be a cold reception from the chair. So with that being said, Mr. Williams, if you could please, Representative Schultz moves the minutes of Thursday, April 19th. Any discussion? Hearing none, all in favor say aye. Aye. Opposed? Motion prevails. Thank you, Representative Schultz. Mr. Williams.
Thank you, Mr. Chair.
Oh, excuse me, Chair Carlson.
Just a clarification on the amendments. There's two ways what you said could be looked at. One would be if a bill has been introduced and heard. Another way would be if the issue has been heard. So if an issue has been heard, you'd be okay with that
Well,
as opposed to a bill?
Chair Carlson, you can offer any amendments you want. That's fine. But I've had some this morning, and nobody sitting at this table, I'm not talking about anybody sitting at this table, but I've had several already this morning where the issues were never heard at all.
Yeah, and Mr. Chairman, that was the clarification I was interested in, because obviously as chair, when you take a certain position about an amendment, that might influence the committee. Maybe not always, but generally.
I hope it does today.
So at any rate, if the issue has been heard, you may have other arguments for or against the amendment, but as opposed to a bill. That's what I was trying to
Yes,
clarify.
as you know, Chair Carlson, we have no rules here, except I think the only rule that I actually have is there can be no placards during committee time in the audience. That's one rule that I guess I have, and I make them up as I go along. But and treats are very effective, yes. And so with that being said, I'm not trying to say you can't offer any amendments that anybody wants to. That's fine. But when I look at some of these, and I'm going, really? I mean, this group is so creative. It's just amazing. So what I'm saying is, any amendments can be. They don't have to have had a hearing. They don't have to do anything. They can be heard. It's just a matter of I am going to be pretty tough on that because I don't want to. I've had several committees this morning that would be affected by issues, and I'm not going to go. And that's just this morning. I'm not going to go. Well, I do. I go talk to the chair and say, hey, what's the deal here? And if they have concerns, then I'm not going to be for it.
Yeah, Mr. Chairman, I understand,
Sure, Carl.
and you're operating like the first time I was on tax committee was 1973. So tax committee has a relatively long tradition of accepting amendments. I'm not talking about that. I'm talking about the stance of the chair, however, can influence the outcome of an amendment by simply saying this bill has never been heard. But if the issue has been heard, I think you're saying that you'd be open to allowing the discussion to take place, and whatever your attitude is toward trying to influence that amendment would be one question, but it wouldn't be necessarily argued that the amendment shouldn't move forward because a bill wasn't heard if the issue was heard. But I think we're on the same page, Mr.
I think
Chairman.
we are, and,
Yeah,
and I want
just wanted to
every
clarify
member.
that.
I never want to be said that a member said, well, the chair wouldn't hear that amendment, because that's not going to happen here. We'll hear them, and then we will have the discussion, we'll make decisions from there. So,
Mr. Chairman, I'm not talking about hearing the
Carlson.
amendment. I understand that. I'm talking about the stance of the chair.
that is yet to be determined, Chair Carlson.
Okay. Then we may or may not be on the same page. Thank you.
We will hear them. We'll hear them all. Okay. Mr. Williams, please continue.
Thank you, Mr. Chair. So continuing with Article 2, Section 11, that updates the definition of the Internal Revenue Code in Chapter 290, which is the main income tax chapter of law, to conform to the 4 acts I mentioned earlier. Section 12 is another section that's just changing a reference from federal adjusted or federal taxable income to federal adjusted gross income. And Section 13 relates to the add back for the federal, state, local income and sales taxes deduction. After the switch to the federal adjusted gross income starting point, we no longer need to add back the amount you deducted on your federal taxes for individuals. So this just limits that add back to trusts and estates. And from there, I'm going to hand it off to Mr. Michael to continue.
Thank you. Please state your name, who you represent for the record, please, sir.
Joel Michael from House Research. I'll continue with the description of Article 1. Section 14 relates to Section 179 addition for individuals, and the Article 1 conforms to the federal changes on Section 179 effective for tax year 18. So there will no longer be an add back for that. So this limits the add back to previous tax years. Section 15 gets, here we're again still in individuals, and it gets into the foreign provisions. If you'll recall from our description of the federal changes, there basically were, because the federal system is going to a territorial system, Congress enacted both a carrot and a stick to discourage discourage companies from shifting income to foreign, shifting domestic income to foreign countries with low tax rates, and provided a stick to encourage them to retain that income in Minnesota. The bill does not adopt either of those provisions. Here, the foreign-derived intangible income is the carrot. So basically what this is doing is saying on the individual side, you have to add back the deduction for your domestic corporations that get this deduction for keeping the income in the U.S. And again, on the individual side, we don't normally think about individuals as having this kind of income, but there are some S corporations. These provisions relate to corporations. There are some S corporations that have this kind of income, and so we have to have additions and subtractions on both the individual and the corporate side. Section 16 is a change to the 529 plan distributions. The federal law allows the use of 529 plans to pay for K-12 expenses. This provision does not conform to that and says that if you use the earnings, the investment return from a 529 plan to pay for K-12 expenses, you have to add that back to your income and pay Minnesota tax on it. Section 17 requires add back of the new 20% qualified business income deduction. This only affects, because this is not involved in computing adjusted gross income, this only will affect trusts and estates because we're using AGI, which does not allow the QBI deduction. So this just is limited to estates and trusts. Section 18 changes the reference from FTI to AGI because of the change. Section 19, because the bill goes to Minnesota definitions of itemized deductions, changes the non-itemizer deduction for charitable contribution to reference the new Minnesota itemized deductions rather than federal deductions. Section 20, again, is just one of those changes of reference from FTI to FAGI. Section 21 resets the dollar amounts of the phase out of the Social Security subtraction because we're resetting all of the indexing. Section 22, now we're back to the foreign provision. This is the stick rather than the carrot, and we're essentially allowing the stick to be subtracted. Again, you know, the federal government is requiring this foreign income to be included in FTI and AGI, so we're allowing the corporations to subtract it because we're not conforming on it. Section 23 allows non-residents who have deemed repatriation income to subtract it. Obviously, this is not Minnesota source income, so we can't tax it. Section 24 essentially requires corporations to add back the new 100% foreign dividend deduction that's in the federal change. Section 25, again, we're back on section 179. This is on the corporate side, and it is again conforming to the new section 179 changes effective for tax year 18. 26, we're back to the GILTI provision. This is on the corporate side, and it allows that income, that foreign income that was included in an FTI to be subtracted. Section 27, one of the things the article does is to repeal the corporate AMT, so section 27 is just eliminating a reference to that. Section 28, one of the things the federal law did was to change how the unrelated business income, that's called, often referred to as UBIT, which exempt organizations, if they have unrelated business investments, are required to pay tax on that. The Congress changed the way those NOLs work so that they have to be done for each activity separately. We're not conforming to that. This is also the way the governor does it. They're still allowed to aggregate their provisions. Section 29 is the reduction in the corporate franchise tax rate. It drops from the current 9.8% to 9.64 for 2018 and 19, and then 9.07 for tax years 20 and later. And I'll switch back to Mr. Williams to go to
Mr. Williams.
individual.
Thank you, Mr. Chair and members. So Section 30 contains the changes to the individual income tax rates that I mentioned earlier. So I think after the adoption of the author's amendment, we'll be at 6.95% for the second tier rate in tax year 18, 6.9% in tax year 19, and 7% in tax year 20. If you look at the text of that section of the bill, it looks like the brackets are being changed, but that's just reinstating the tax year 2018 amounts that are already sort of established by the Department of Revenue. So there's no actual substantive change to the brackets. Section 31 updates the section as to how the brackets will be indexed and instead indexes the brackets using chain CPI. Section 32 and 33 and 34 also changes to the dependent care credit, but it's again just a change related to the indexing. It would switch all the phase-out thresholds for that program to be indexed using chain CPI. It also adds to the definition of income for the purposes of the dependent care credit alimony. So under the Tax Cuts and Job Act, alimony for separations that were executed sort of after the enactment of the bill, alimony payments are subject to tax are subject to tax. So it would just add those definitions for the purposes of the dependent care credit. In section 35 and 36, that's again a change to the indexing for the purposes of the working family credits. So the income thresholds for the working family credit would be are rebased and then indexed according to chain CPI. Section 37 is a conforming change to the long-term care credit. So it contained previously a reference to federal itemized deductions, and it updates that reference to reference Minnesota's new state itemized deduction. And Section 38 changes a reference from adjusted taxable income to federal adjusted gross, or to Minnesota taxable income. Sections 39 through 42 are changes to the historic structure rehabilitation credit. So under the Tax Cuts and Job Act, we're sort of mirroring the federal treatment of the historic rehabilitation credit at the state level. So it essentially allows you to take the credit in 5 equal annual installments. And so this would allow the state credit to be taken in the same way. Section 43 it relates to the 529 plan credit that was enacted last year. So there's sort of 2 changes. Section 44 updates the phase-outs to be indexed by chain CPI. And Section 43 would exclude amounts used. So if you use amounts from a 529 plan to pay for K-12 education expenses, as Mr. Michael explained, we're not conforming to that, so you could not use those amounts to claim the 529 credit. And Section 45 is another switch from AGI to federal taxable income for the purposes of the elderly exclusion. Section 46 is sort of some of the meat of the changes specifically related to itemized deductions. So if you look at pages 10 and 11 of your summary, you can sort of see in a table there what sort of is allowed under present law and what is allowed under the article. So you'd see that that's the section that contains the exemption amounts that I mentioned at the start. So we're matching what's allowed, what the announced amount for tax year 18 was going to be under federal law. You'll see the increases and the changes in the standard deductions. You'll see the changes in the itemized deductions that are allowed under present law if we didn't conform, and then what's proposed in the article. So there's a cap on the amount of property taxes you can deduct. There's a decrease in the threshold for the medical expense deduction. So under old law, you could claim that if your medical expenses exceeded 10% of your adjusted gross income, and we reduced that to 7.5% of adjusted gross income. Related to home mortgage interest, the TCJA lowered the amount of acquisition indebtedness that could be used to claim the mortgage interest deduction from $1 million to $750,000, and so we conform on that. And then we also conform on not allowing interest from home equity loans to be deductible if it's not used to sort of improve the principal residence. The TCJA also increased the AGI limit for the charitable contribution deduction to 60%, so we conform on that for the state. The TCJA disallowed the casualty loss deduction unless the loss occurred in a qualified disaster area, so we conform on that provision as well. And then the TCJA repealed the miscellaneous itemized deductions category that are subject to the 2% AGI floor. So that's things like tax preparation expenses, unreimbursed employee business expenses, safety deposit box rentals. And so we conform on the elimination of those deductions. Section 47 changes the definition of income for the purposes of the individual AMT to require the addition of qualified business income. That's a provision we're not conforming on. And Section 49 indexes the AMT exemption amounts. It rebases them and then indexes them according to chain CPI.
Mr. Mike.
Mr. Chairman, continuing on with Section 49, as I indicated before, the article repeals the corporate AMT. This was Representative Sarah Anderson's bill. And so Section 49 is the provision that continues the carryover credit that allows businesses that paid AMT in the past to carry forward their AMT credit and reduce their regular tax by it. Section 50 converts indexing of the minimum fee to the new chain CPI. Section 51 clarifies that when we update for corporate NOLs, we're not applying the 20% haircut to our version of the NOLs, which the TCJA does to the federal. And because we follow federal on NOLs for individuals, we are conforming on individuals. We're just not conforming on corporations on that. Section 52 modifies the rules for assignment of income by individuals to add a reference to a new type of qualified stock that's allowed under the federal TCJA, which is generally referred to in the business now as Section 83I, qualified stocks, so that that's treated as wage income. Section 53 is a clarification that says the deemed repatriation tax income, this is that one-time recapture or payment of tax on deferred foreign income, that will be treated as a dividend for Minnesota purposes. That's the way we've treated Subpart F income in the past and the way we treated the repatriation holiday that was enacted in 2004. So that sort of just confirms existing practice. Section 54 is a clarifying provision related to insurance companies and how the interest limit applies to them. Insurance companies are a strange animal because most of them do not. The insurance companies that pay Minnesota premium tax are generally exempt from the corporate franchise tax, but they may be part of a unitary business that has non-insurance companies that pay corporate franchise tax. And the federal limit on interest, this is the 30% limit on interest deduction that was enacted as part of the TCJA, allows for corporations, for groups filing consolidated returns that they aggregate all of their income in computing how much of that 30% interest limit applies. Now, for Minnesota purposes, some of those entities will not file corporate returns because they're exempt insurance companies. This provision says that essentially for the non-insurance companies that are subject to corporate franchise tax, they will calculate their interest limit the same way they did for federal purposes, and Minnesota is not going to say, well, you have to recalculate that only based on the non-insurance part of the business. So they will simply take over their the amount from their FTI. It's not, there won't be any change as a result. So,
Thanks for clearing that up for us.
Mr. Chairman.
I
you're
was
welcome.
actually following. Yeah.
I know you were. Section 55, we're back to the Section 83I stock. This just says that the withholding tax applies to that. I'll let Mr. Williams go over the property tax refund provisions, and then I'll come back for the estate tax.
Thank you, Mr. Michael. Mr. Williams.
Thank you, Mr. Chair. So sections 56, 57, 58, and 59 relate to the property tax refund program. So a lot of this is not substantive changes. It's just sort of updating for the changes that happen as a result of conforming to the TCJA. So previously, there was a cross-reference to the federal dependent exemption amount. So we instead cross-reference to the state dependent exemption amount that we're instituting. There's another, for the purposes of the property tax refund, we're requiring that alimony be added to as part of income. So that sort of matches the treatment under old law. And it's only going to be for divorce or separations executed after the TCJA was enacted. So it's sort of forward-looking only. And then it also updates, it rebases all of the tables, but there's no actual substantive change in the tables. It's the same as the announced tables for next payable, refund payable year. But there's also, there's a minor error in the summary. So it mistakenly says that the indexing for the purposes of the property tax refund will be switched to chain CPI, but the bill retains indexing the PTR program by the consumer price index for all urban consumers, which matches the indexing under old law. And that's pretty much all of the changes in the PTR.
Mr. Michael.
Mr. Chairman, members of the committee, Section 60 updates the estate tax for the federal changes. That really has no substantive impact. 61 changes the sales tax to not update, and this relates in the sales tax in the isolated and occasional sales exemption. One of the ways you can qualify for that is by having a like-kind exchange. And of course, as many of you remember, for when we heard the TCJA Act provisions, one of the things that the TCJA did was to say that like-kind exchanges are limited to real property. So if we had updated the sales tax for that, that exemption would not apply, because obviously the sales tax doesn't apply to real property exchanges. It only applies to equipment and personal property and that sort of thing. So what we're doing here is to saying that exemption is linked to old federal law, not the updated federal law. Section 62 is the similar provision in the motor vehicle sales tax. Section 63, 64, 65 all make changes from FTI to FAGI in various provisions that use the federal income measure, the first-time home buyer program that was enacted last year, and the Job Z subtraction, which is now virtually gone, but I think there are 5 businesses or so that still qualify for that. Section 66 eliminates a reference to the corporate AMT, which is being repealed. Section 67 is the repealer. These are all provisions that become obsolete as a result of switching to FTI or because we're conforming to various provisions that the federal, a couple of them that I'll highlight are subtraction for subnational foreign taxes. These are subnational foreign taxes other than Canadian provincial taxes, which is currently a subtraction, is being converted in the bill to an itemized deduction for taxes. So that's one change to highlight. The other thing is that Minnesota has disallowed fines, fees, and penalties, and Congress saw fit to follow Minnesota, enacting that as part of federal law, and so we can repeal those provisions as well. With that, we've completed Article 1. I'll go on to Article 2, which is a variety of individual, corporate, and estate tax provisions from individual bills. Section 1 allocates an additional $10 million for the Angel Credit program for calendar 2018 allocations. Section 2 is a conforming change with regard to that. Section 3 and Section 4 and Section 8 are from Representative David's bill that is changing the way we're changing the definition of captive insurance companies. This is the version that's in the bill is in Article 2 is the way it was in the introduced bill. Their discussions are ongoing with the Department of Revenue to modify these provisions to address the concerns that they have, so that there will at some point, probably in conference committee, be an amendment to address that as discussions go on. Section 5 is from Representative Garofalo's bill that provided that essentially the business expenses of medical cannabis producers will be allowed to be deducted, notwithstanding the fact that under federal law, they're under IRC 280E, they're disallowed. And Section 7 is also part of that same bill. And then there's later on in 14, there's the similar provision that adjusts the individual AMT. Because the bill repeals the corporate AMT, we don't need to do anything with the corporate AMT. Section 6 and Section 9 is the chair's bill that was heard back in 2017 that allows a 20% non-refundable tax credits to businesses that make donations of prepared foods. This is essentially the credit for restaurants that contribute prepared food. The next provisions are in sections 10 and 11 is Representative Hertas's bill that modifies the stillbirth credit, extending it, making technical changes and extending it to instances that occur where Minnesota residents have a stillbirth outside the state, they can still get the credit. Section 12 is Representative Erdahl's modification to the credit for teachers who get master's degrees to allow it for teachers who get master's degrees in special education. Section 13 is Representative Gruenhagen's railroad crossing credit bill that allows a 50% credit for essentially railroads that make crossing improvements that are designated by the Department of Transportation as being a high priority. So that completes all of the income and sales tax, the income and corporate tax provisions. The next new provision is section 17 and 18, and this is from Representative Smith's bill on the estate tax that essentially for purposes of the qualified property exemption for farms and small businesses, that it treats ownerships by either of the spouses as being interchangeable in order to qualify under the 3-year holding period requirement that applies to those provisions. The final provision in this article is section 19. This is Representative Backer's estate tax bill. If you'll recall, this was an instance where the estate, when it filed its return, made the mistake of foregoing claiming the general exemption and instead zeroed out their tax by claiming the qualified farm exemption. Essentially what this provision does is it says for a period through January 1st of 2017, we're going to give those estates that did that a do-over to go back and refile their return and claim instead the general exemption and then claim the qualified exemption. That will be reduce the amount of recapture tax that they owe. I believe from what Revenue has told me that there may be, just a handful of estates that will be affected by this, less than 10, and I think the cost is $400,000. This is slightly different than the way Representative Backer introduced his bill, which made it a permanent provision. That completes Article 2. And we'll turn it over to the people that want to talk about sales tax and property tax.
Thank you, Mr. Michael. Thank you, Mr. Williams.
Okay.
Mr. Chair, members of the committee, for the record, I'm Pat Dalton with House Research,
Welcome to the committee.
and I will take you very briefly through Articles 3 and 4. Sections 1 through 5 and 7 of Article 3 is Representative Liebling's bill that basically simplifies or allows massage therapists to simplify their tax treatment by either choosing to pay the provider tax or choosing to remain under the sales tax. Section 6 modifies the exemption for precious metal bullion that was passed last year to include bullion coin. Section 8 is Representative McDonald's bill providing an exemption for herbicides used to handle invasive aquatic plant management by lakeshore property owners, by their associations. Section 9 provides the sales tax exemption for the extra price paid to sit in a preferred area at college sporting events, if the money is going completely to support student scholarships. Sections 10 and 13 relate to providing sales tax exemptions for lawful gambling. One is for prizes and one is for their equipment. Section 11 relates to the underserved medical facilities and provides a sales tax exemption. That the definition is actually included in the property tax articles, which is in another amendment. Section 12 is the ice arena. Last year, there was an exemption provided for operating an ice arena in Duluth, and this is expanded to one, the David Thaler Sports Center. Section 14 provides a sales tax exemption to nonprofit conservation clubs that provide training in shooting. Section 15 actually combines several bills providing an upfront exemption for various public safety facilities, including the fire station in Inver Grove Heights, a new fire station or remodeling of an existing fire station in the city of Virginia, a new fire station in the city of Minnetonka, and the remodeling of a fire station in Minnetonka to make it a police station. Section 16 provides the sales tax construction exemption for Second Harvest Heartland. Section 17 piggybacks on an exemption that was passed last year that allowed nonprofit snowmobile clubs to a sales tax exemption for construction and maintenance of grant and aid snowmobile trails. This also gives them an exemption for building materials used for bridges and other things that they need to do. Section 19 is the sales tax exemption for reconstruction of properties destroyed by fire in Mazeppa. Section 20 provides a construction exemption for a private redevelopment project on the site of the former Duluth Central High School. Sections 21 through 23 are just conforming changes needed for places where the construction exemption isn't an upfront exemption. It has to be done as a refund. Section 25 is a refund on retroactive sales tax exemption for a municipality-owned water facility owned by the city of Elko Newmarket. And Section 26 is the chair's bill requiring a sales tax rate adjustment if taxes are imposed on remote sellers, either due to a federal law or the overturning of the Quill case. Article 4 essentially has two sets of provisions. The vast majority of the article deals with unmanned aircraft. It defines what they are. It provides a $25 registration fee instead of the regular aircraft fee. It states that that fee is not refundable if the unmanned drone is destroyed. and it provides money for refunds if somebody paid the aircraft fee as well as the drone fee. Sections 5 and 6 relate to something that had been in the property tax division. This is the $97,000 one-time to Hermantown, and it also puts back to Lilydale a $150,000 one-time payment to help with sewer costs. However, Section 6 basically increases the appropriations, so the money is coming from the state and not from other cities' LGA. Articles 5 through 12 are the Department of Revenue policy and technical bills, and I think it's actually easier to go through the list of what was removed from those articles. What was removed from the articles was fractional homesteads, which is dealt with in the Property Tax Division report, resort homesteads, which is also dealt with in the Property Tax Division report, the sales tax modifications for data centers is also removed, and I will let Mr. Michael talk about anything that was done in the income taxes.
Mr. Mike.
Mr. Chairman, members of the committee, there are two material changes in the, let's see, it's in the partnership, in Article 7, which includes the department's proposal to deal with the new federal partnership audit regime where audits will occur at the partnership level rather than the partner level. The first one of those is there's a change in the statute of limitations when that's told when there's a federal audit. If that audit finds no change, under current law, the Department of Revenue has a 6-month extension after that to make Minnesota changes. That provision is repealed so that if the federal audit shows no change, then the statute ends at that point and does not, and the Department of Revenue does not get an additional 6 months. The second change is that, which is, if you recall, when the bill was heard, that I believe the chamber and various business groups testified that they were concerned about the requirement that was in the department's proposal that assessments identify, and again, this is at the partnership level, identify when there are indirect partners who are residents. And, you know, to just refresh your memory, we're talking about instances where there are tiered partnerships. So you have several different levels of partnership. Indirect partners are, as contrasted with direct partners, are partners that are down 2 or more tiers below. And what the provision that's in the article is that it eliminates the requirement that the partnership identify indirect partners who are residents when there's an assessment. So it would only be the direct partners, which is the first tier level.
Okay. Mr. Michael, we're going to stop right there. I went a little bit over here. So we're going to pick up with you, Mr. Michael, and anyone else from House Research, and then we will go to House Fiscal. And so we'll meet again a half hour after session in this room, so you can just leave your things here. I'm so excited about this bill. I mean, it's just a page turner. It's just really exciting. So we'll come back a half hour. We'll finish up. Yeah. Again, just for a refresher, we'll finish up with Mr. Michael, and
We're done.
all of House Research is done?
Well, on this,
On this,
Oh, go to claim.
well,
Okay.
Well, then the property tax division. stuff,
Okay, so we'll
right.
pick up with that, and then we'll go to fiscal, and then we'll go to public testimony with the commissioner being first, and then we'll go to, after the public testimony, we'll go to recess for about an hour, and then we'll mark up the bill with amendments. And so members, just, and again, we're going to have to coordinate with Ways and Means. I want everybody, I don't want anyone to be missing votes in Ways and Means, because they're doing very important work over there also. So with that, I wrote it down here. We are in recess, right?